Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me for this segment, we have Marcus, founder and CEO of InvestX, to discuss public and private market trends in 2022 and what to look for in 2023. Marcus, it's great to see you again. Welcome back to Trade Talks.
Hey, great to see you again as well, Jill.
What are the most important private equity trends that shape 2022, and how is the bear market impacting private equity?
Yeah, well, one of the big issues really was issuers were trying to avoid refinancing at all costs. And we saw kind of the early North Star with Klarna. I don't know if you remember it or not, but back in second quarter, the last round was $40 billion. They were losing a lot of money. They needed capital. So they raised $800 million at $6.3 billion. So this was really, I think, kind of the shot across the bow of all the issuers who were saying, we have to extend our balance sheet no matter what happens, right? We can't have something that tragic happen. And so I think what we saw was the VC-backed companies were the first to really start to lay off people, reduce their costs, because they knew if they had to go to market in Q2 or Q3 this year and Q4 to some degree, it'd be really significant. The other piece that we saw too is really I would say the institutional bid went away, right? In terms of, primaries that historically in the venture-backed community and growth equity or pre-IPO companies were being done about every 18 to 20 months. And so those were being extended because a lot of people did raise money in 21, which is important. But the institutional bid, when you went to the secondary market, really fell apart. And it's just been really, to a lot of degree, people were expecting, if the IPO window's closed, which it has been, will there be more secondary trading? Because people need liquidity. But what we saw was sellers really anchored in on 2021 prices and valuations. So they weren't coming down. And the institutional bid had so much uncertainty with the recession, the war, and all those different factors that we all know about. And so the bids were actually really low. And so we started off the year probably at a 30-40% spread in the bid and offers. And I would say only recently, maybe in the last 8 weeks or so, or 6 weeks, we've actually started to see them come together. And by the way, it's not the bids coming up. It's the sellers actually coming down. And you know what happens, Jill? You get one trade that happens and all of a sudden everyone's now anchored in new expectation. And so now you need liquidity. And we saw a lot of layoffs happen too. So a lot more people in 2022 now need liquidity because they have to exercise their options or get some of that equity rewards from working there a long time before they're laid off. So I think these are some of the kind of key things that we saw kind of this year so far.
Yeah, that's a massive spread to contend with there. Where does InvestX fit in the private equity ecosystem, and what solutions do you provide?
Yeah, so as you know, the private markets are super inefficient, right? I always joke in the public markets, they're so efficient, you can't beat the Goldman Sachs computers. The private market is the exact opposite. It's really like a 1980s OTC market. There's no ability to find buyers and sellers. So trade execution is really, really difficult. There's no ability to find pricing. How does price discovery actually work? And so InvestX really set out to solve two things. One is to provide access to broker-dealer clients, the ability for them to get access to invest in this market and get the return profile. So we have a number of investment products like dedicated funds and single funds. And then what we did is when we're investing in these issuers, which are amazing businesses, we found that in the secondary market, it was so inefficient that we needed really a technology solution to be able to help that. And so we built an inter-dealer platform. It's almost like really a matchmaking service on some level because it's not electronified. It's so inefficient, but nevertheless, institutions could then block trade. So if you need to sell $30 million Fidelity or $50 million of Klarna, for example, there's a way that you could actually find more than one bid or offer in a single place so that you could get better price discovery and trade execution. And this is the platform that Jefferies and Virtu and Canaccord invested in to help actually create a little bit more efficiency in this market. So that's what we try to solve. We try to help people get access to the market in terms of our investment products, and then we help institutions to be able to get liquidity in a very, very inefficient market.
What are you predicting for 2023 in the private markets? Do you think we'll return to bull market territory?
Well, the only way to return to bull market territory is we need the IPO markets to open up, right? And right now they're, as you know, closed. I think this year there was 2 tech IPOs, something like that. You probably know actually even better than me, Jill. But so that's a real challenge, right? And I think the other issue is that there was a lot of crossover funds, and hedge funds that came into this market over the last 5 years. Tiger is a perfect example. And Tiger kind of took I would say, I kind of joke like those Tommy guns from the 20s, this approach of shoot as many as you can, as fast as you can. And part of the reason for doing that was that the markets are very competitive for these types of primaries. These are world-class companies. People want to own them before they go public because a lot of that kind of IRR was created in the private markets. And so Tiger started to actually invest in a lot of things. I joke, it's almost like an ETF. They try to add almost everything to it. But what they did as a result of that is they sped up where the issuers really had kind of control over pricing, right? Because they had the control over all those other different aspects. And so as we think about kind of it getting back in the bull market, those companies like Tiger and SoftBank and Coatue, et cetera, they've now stepped back, right? They bought so many things. Their hedge funds have gone down so much. They've now kind of come off market. And so the institutional bid has to come back into the market in order for us to see something change. And right now, a lot of those traditional crossover ventures are all on the side. They've actually got more criteria now than they used to in terms of how they select things. It's not happening at the rapid pace. So those are going to be key things for next year.
Right. And before we get into my last question here, with IPOs still lagging in 2023, or if we expect to see an increase here, don't you think this valuation reset and rethinking what priorities look like in terms of investments kind of needed to happen? I mean, it's so hard to value companies on what they project their next 3 to 5 year earnings are when there is no clear path to profitability. Management teams certainly need experience to weather a bear market that probably a number of them have never even experienced. The market kind of goes through these cycles every 10, 15 years.
Yeah, it does. It's really important. Like, for example, in our investment business, one of the things we look at right now, one of our primary factors is what we call efficiency ratio, which is basically your EBITDA percentage plus your growth rate, right? And our investment team looked at 84 companies this year, and we found only 2 companies over 70. We found a few in the 60s, but the key element there is what's your EBITDA, what's your cash flow, right? And so I think to some degree, companies that are losing a ton of money right now, where they actually have to go and refinance, they're almost uninvestable right now. Right? Until you reset, to your point, Jill, until they actually do a new round that's going to reset their capital base, that gets them a clear kind of path to profitability, you can't invest in them. They're very, very difficult to invest in. So it will change, obviously, as they get recapitalized and we see a clear path. But that's all we look for in our investment business, is basically companies that are profitable today.
Right. Especially when you think about the IPO market, who at the end of the day is the one holding these companies with valuations that make no sense? It's the public investor, right? And you don't want the public investor losing confidence in the capital markets, because that was a key theme in 2021. Like these they IPO and then they never saw that price for the remainder of the year. And certainly, there's many of them are in single digits now. And again, it's the public investor that holds the bag at the end of the day.
Well, especially because of lockups, right? Because the institutional investors getting the actual IPO shares and the public investors getting it 6 months later. Right. And I think the stats are something in the early 90s, low 90% of IPOs last year that actually are trading above that price. Right. To come back to your point. So, but I think if you look forward into this next year, the market can't get any worse. There's 2 tech IPOs this year, roughly, so, but I think what we need is a couple of things, right? We need institutional capital flowing back. And so there's a couple of factors that we're looking for. So number one is, are we starting to see block trades happen back in these growth stocks again? Where a Fidelity might go to a Jefferies and put $500 million to them and say, look, I want you to take it, 2% off the pricing. And then, but Jefferies feels confident enough that they can take that on and then distribute it in the next hour to other institutional clients. And so this is where we start to see institutional bids coming back in the market. So that's a factor we're looking for. The other one is, are they refinancing those converts, right? So our private companies refinancing the convertibles, because again, you're seeing new institutional bids coming back in to replace older terms, right? But again, we're seeing more institutional money come in there. And then finally, third is a secondary platform like our GEM platform, where we're seeing picking up a volume where institutional bids are coming in versus right now more family office bids, right? And so if we see institutional bids coming in, I think those will be really important pieces, because the issuer is looking at it and is saying, there's no way we can IPO today and have the price collapse because there's no support. We've been private for 10 years and 12 years. We have a lot of people that need liquidity, right? And they don't want a failed IPO. And we have an amazing investment, a company called Instacart. They've confidentially filed, it's been well reported over the last year. Probably one of the better companies who's going to come to the market next year. But you definitely see, in a profitable business, they don't need to raise the capital. Don't go to market until it's changed, because you don't want a failed IPO because all the consequences that we know about that.
Yeah. All right, Marcus, appreciate your insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Great to see you, Jill. Thanks for having me.